Hi, I'm James from Maddisons Residential, and I'm here this morning with Jack Sales of TN Accountancy, and wanted to record a piece having had questions recently from landlords of ours regards the tax situation and our thoughts on what's happening in the economy at the present moment and changes that have happened to the tax regime as of the last mini budget, although I think a lot of those have now been reversed. Jack, welcome.
Thanks for having me.
Great to see you. I thought let's perhaps start by understanding what actually, I think almost everything has been reversed by Mr. Hunt, but perhaps if you could just clarify, especially with tax matters and those relevant to our landlords.
Yeah, absolutely. So there were a raft of changes in the mini budget to tax. There was probably more going on in that one statement than there has been in probably in 5 years worth of budgets. So there's an awful lot going on, and then very quickly everything went wrong, and Jeremy Hunt has reversed almost everything. The only couple of things from a tax perspective that have remained, one being national insurance change, but that's not really relevant for landlords, and the other being the changes to stamp duty. So just to recap, those were where the nil rate ban, so that first part of the property value that's subject to 0% stamp duty, that used to be 100. That currently is 125,000. That's been being doubled to 250,000,
Okay.
and for first-time buyers, that was 300,000. It was going to be going up to 425,000 on properties up to a value of 620,000. So there's some extensions to the kind of the basic rates of stamp duty, or the nil rates of stamp duty. I think it's more of a reflection of the fact that property prices have jumped up so much since the legislation was originally written.
Yeah, absolutely. Oh, that's very true. I know that certainly we'd hoped, our landlords had hoped perhaps a little bit more help towards maybe reducing the 3% surcharge, but we'll see what happens.
Mm-hmm.
But now specifically towards landlords, one of the areas that we're very aware of are some of these changes to capital gains tax that have been made.
Mm-hmm.
And the requirement for not only reporting the capital gains on the sale of any properties, because there's an awful lot of comment in the press at the moment about landlords selling part of their rental portfolio. Equally, that is counteracted by some buying other rental properties, but let's focus on those that are selling.
Mm-hmm.
There have been changes to capital gains tax that we're fearful a lot of people have missed out on. So if you could perhaps just tell us a little bit about that.
Yeah, absolutely. So there were a couple of changes in the last couple of years. The main one that has been catching people out in our experience has been mainly around the reporting requirement. So wind back 3 years or so, if you sell a property and you have to pay capital gains tax on it on the sale, you would report that property sale in your self-assessment tax return. So you could sell a property in, say, I don't know, December, and then you wouldn't have to report it in your tax return until basically the following year. So you'd have a lot of time to report that. As of April 2020, HMRC brought in an additional reporting requirement where you still have to put it in your tax return, but you also have to report the sale to HMRC within 60 days of the completion, and that is in the form of a specific online CGT return,
Right.
And any tax that's due has to be paid at the same time as well. So you've kind of got this huge acceleration of reporting the gain and paying any capital gains tax versus what was the case before. At the same time, HMRC also made some changes to the actual CGT, the tax calculation. So there were a couple of tax reliefs that were available that have either been scaled back or effectively abolished. You might have been familiar with lettings relief back in the day. That's pretty much gone. On any sale, that landlords don't get that, unfortunately, and principal private residence relief, that's been scaled back a little bit as well.
Okay, so I think the key thing is really that you've sold a property, you've completed on a second property or additional property to your main residence, and you've got to report that on this specific CGT portal on the government website. We'll have that on the screen now, actually, so hopefully you'll be seeing that. And then pay the tax within 60 days, as well as then reporting it in the January following.
Exactly, yeah. So you're paying your tax effectively at or around the time of the sale, and then when you come to put it in your self-assessment tax return, you've already paid the tax, but you've got to actually report the gain in your self-assessment return, and you get credit for the tax that you've already paid.
Lovely, thanks for clarifying that. I mean, during your explanation of that, you mentioned the lettings relief and some of these reliefs that have been scaled back for landlords. Property is still a great investment. We've seen property prices rising over the years. What other reliefs are, what existing reliefs are there for landlords and in relation to investment property?
Yeah, so with regards to investment property, just to sort of bring it back one step, if you like. So if you sell all property that you own and you sell is technically subject to capital gains tax. So if it's gone up in value from when you bought it, you pay tax on that profit, so the gain that you make. And the top rate of capital gains tax is 28% on residential property. Now, there are exemptions that can exempt that capital gain, and then there's also some reliefs. So the exemptions, the main one that we would sort of look at, particularly with regards to property, is principal private residence relief. So basically, property owners get tax relief, or an exemption, for the period that they've lived in the property as their main residence. So this is why when people buy and sell their own homes, they don't have to worry about tax, because it's been their own home, their main home, for the whole period of ownership. So they don't have to worry about tax, because that's, HMRC don't want to tax people when they're selling their own house. Where the property hasn't been their main residence, so main example is a landlord and they have it as a rental property, that isn't covered by any principal private residence relief. So effectively, they would be subject to capital gains tax on the appreciation of the property. If you have a scenario where someone, and this is often where people become kind of accidental landlords. Yeah. They live in a property, they buy another one, they might meet someone, they have a partner, and they decide to keep their old flat. This is very common. And they have a flat, their partner has a flat, and then they both decide to buy a house together, and they decide not to sell their flats, and they will rent them out, so they have a bit of rental income. When they come to sell those flats in the future, they might have owned that flat for 10 years, and they might have lived in it for 5. So they've lived in it for half of the period that they've owned it. 50% of the capital gain, broadly speaking, is going to be exempt, and 50% is going to be taxable. So that's broadly how the relief works. There are a number of little quirks within the principal private residence relief, the PPR legislation. So there's a few kind of potential opportunities to try and extract as much relief from that as possible, depending on certain situations. In terms of other reliefs, we mentioned lettings relief before. That's kind of been and gone. That used to be a really handy relief back in the day. That's no longer the case. HMRC, it's still around, but in a form that not many people can really use. The other main thing to consider is the capital gains tax annual exemption. So anyone who sells anything that's subject to capital gains tax, the first £12,300 of the gain is taxed at 0%. So if they, for whatever reason, they're sharing things out between couples or anything like that, or the gain is only, say, 15 grand, the majority of that is going to be 0% tax, and only the top slice is going to be taxable at 28%. So that's a kind of a relief that everyone gets. Beyond that, it's more down to really sort of looking at individual circumstances and looking at what tax planning can be done.
On the property and
exactly. So all the costs associated with buying, selling, and also doing up the property can potentially be set against the capital gain to reduce the tax.
I think one of the interesting things that you mentioned there was accidental landlords, and we have a number of accidental landlords that we look after on the books at Maddisons, and it's those that perhaps have a deliberate policy. We've also got some people that have made or are making a deliberate choice to invest in property. Now, people have talked about having a company and owning properties within a company. Could you give us perhaps a quick snapshot of what it is to own, the benefits of having properties within the company, and if people wanted to move existing rental properties into a company, what they need to take caution of? I'm guessing capital gains tax must be one of those, and therefore roll back and listen to what you just said.
So with regards to holding investment property within a company, so it's been a key area for landlords to be looking at over the last few years, because about 5 years ago HMRC introduced some legislation that restricted the tax relief on mortgage interest for landlords. So landlords who have a mortgage on a rental property and they own it personally will be very aware of the fact that they're not getting as much tax relief on their mortgage interest compared to, say, 5 years ago.
Especially now since mortgage rates have gone up.
Exactly, yeah. So it's a very pertinent point right now. When rental property is held within a company, that same restriction doesn't apply. So you get full tax relief on mortgage interest when you hold it within a company. The complication, if you like, or the hurdle is more around if you have an existing property portfolio, you've got to get the property from your personal name into the company.
Right.
And there are two tax charges that need to be considered at that point. So where an individual transfers a property into a company that is their own company, it's deemed to be a sale, in inverted commas, of the property at its market value at that point. That will be subject to, in the hands of the individual, that will be a sale subject to capital gains tax. So got the tax to pay, got to report it within 60 days.
Okay.
And then for the company, there's also a charge to stamp duty as well. So the property is effectively deemed to be acquiring the property at its market value. Okay. So there's a double whammy there. So that we're finding with a lot of our clients, it just doesn't make sense to transfer the properties into a company. Clients are having to think about other alternative strategies with their property investments because it's such a big tax hurdle for them to get over.
Sure.
If you're looking to buy a new property, so if you're just starting out or you're a seasoned landlord but you're looking to invest in more properties, it's definitely worth looking at going down the company route, because you don't have the same initial upfront tax charges, because you're effectively just putting cash into the company. So generally, you kind of have put some cash into the company to cover deposit and a bit of money, working capital, if you like, for the company, and then the company can borrow, get a mortgage to fund the purchase of properties. So it's mainly around the transfer of property into a company that's the hurdle. But there are certainly those upsides of having a company. In terms of just on that mortgage interest point, there is one other way in which that effectively a way around that mortgage interest restriction if you hold property personally, and that's just quickly. I'll just quickly cover off around holding the property. Running the property, so renting out in a slightly different way. So if you have a normal buy-to-let, it's just considered a normal rental property. If it's qualifies as a furnished holiday let, and there are some specific conditions in order that need to be met in order to satisfy that. But broadly speaking, the sort of things that would kind of fall into that category would be more akin to an Airbnb type arrangement. Yeah. If it qualifies as furnished holiday let, you can hold the property personally, and you can still get all the tax relief on your mortgage interest because it's not subject to that same restriction. Okay. So it's an interesting one, and again, it depends on the individual circumstances, because not everyone's got a property that is kind of geared up for your kind of short-term holiday lets. But if you do, then it's potentially an area that might be worth considering.
It is an interesting point, actually. We recorded a vlog earlier in the summer about the number of Airbnbs, and I hadn't realised the number of Airbnbs in Tunbridge Wells, or indeed Sevenoaks, in excess of 500 between the two towns. So it's I think more landlords are clearly aware of that, perhaps, and that have moved across to report properties on the short-term rentals. But Jack, thank you ever so much for your time. Obviously, what we've heard in the last sort of 48 hours is that the budget, if you like, autumn statement is going to have been put back from 31st of October to 17th of November. So we will obviously be keeping in touch, and if there are any changes announced on the 17th of November, we will be sure to let you know just as soon as we're able. But many thanks for watching. I hope that that's been helpful, and of course if you've got any questions, please don't hesitate to contact either the team here at Maddisons or indeed Jack and his colleagues at TN Accountancy, and we'll be delighted to make an introduction to Jack. Many thanks indeed, all the best.